Hey guys, welcome to today's podcast. And I've got a fantastic guest for you today, Clint Harris. And he's a real estate investor. He's got a background in the medical devices industry and he started Nomad Capital. We'll hear all about what that is. He retired through self storage. So I'm really happy to have him on the show. So, Clint, welcome.
Thank you. Excited to be here. I appreciate your time today.
Yeah, I know your time is very valuable. So kind of, set the stage and talk about, your journey and then how you founded Nomad Capital, and we'll get into self-storage.
Sure. So my name is Clint Harris. I'm one of the general partners with Nomad Capital. I'm 41 years old, married, two little boys, 4 years old and 1.5. Live at the beach in Wilmington, North Carolina. I had a 16-year career implanting pacemakers and defibrillators as a medical sales rep. That lifestyle is, it's kind of grinding. It's kind of a young man's game, a lot of call, a lot of nights and weekends. I'm sure like a lot of your listeners, heart problems is not Monday through Friday, 9 to 5, right? So getting called 2, 3 in the morning up to a couple hours away for pacemakers or defibrillators or someone getting shocked by their device or something like that. So I love my job. I was blessed to be good at it, but I always knew that at some point I needed to create an off-ramp from that. So I chose real estate as the avenue that I was going to do that. I built up a small portfolio of 9 single-family properties before I realized that was a very slow way to get ahead. And then, like a lot of investors, I made the move to small multifamily properties. When I moved to Wilmington, North Carolina, I took a promotion in 2017 to move to the beach and build a new territory. And at the beach, that opened up the opportunity for short-term rentals. So I started buying small multifamily properties with bad long-term tenants in them near the beach, within blocks of the beach on the island where we live, and converting them into short-term rentals. So we still own 14 short-term rentals. And the problem then was I achieved a level of financial independence, but I did not achieve location or time independence, right? I was still locked in one place. I still had my phone on me. Even when I wasn't working, I was the equivalent of being on call because of the management of these properties. So that turned into starting a property management company. I couldn't find a company to manage my business the way that I would manage my business. So with some partners, we built a property management company. It manages my 14 listings plus about another 75. I completely hired myself out of that. And things were good. But again, I missed with what my goal was, or more accurately, I didn't have the right goal. I was focusing on financial independence. And what I should have been focused on was financial time and location independence, because those 3 things together create an independence of purpose that gives you the ability to choose what the rest of your life looks like. So things meaningfully changed for us in 2021. I believe in the power of networking and relationships and podcasts. Through local networking, I met my partners, which are a father and son team that had years of commercial construction and self-storage background. And we bought an old Kmart building that had been vacant for years. And we bought that building for pennies on the dollar. We converted that into a climate-controlled self-storage facility. And we can talk about that a little bit more, but about the strategy and the cost per square foot. But we converted that into a climate-controlled self-storage. And that changed our life in a very meaningful way from the financial trajectory standpoint. I raised money from that deal from a handful of the cardiologists and surgeons that I was buddies with, that I was working with at the hospital. So we partnered together. We did that deal. Went very well. So we did another one, then another one, then another one. And then in 2022, I left medical sales behind. I'm a full-time real estate investor with Nomad Capital. And we're currently sitting, since starting syndication in 2021, we're currently sitting at $150 million in assets under management right now.
Yeah, interesting. It's not, landlord, it's like nothing's better than just, having the cash flow and then being called at 3 in the morning, for, toilet or, all these, very irritating issues. So kind of talk about, I love the audience. They're sophisticated investors, so we don't need to talk about kind of the nuts and bolts. We'll just talk about the real estate industry as a whole. And I know, for example, commercial is really struggling and, interest rates are sky high. So what sectors within, the real estate industry are performing well, or which ones should investors be looking at, positioning themselves?
Yeah, great question. So Obviously, we had the fastest and highest interest rates increase in history recently. So basically, anybody who is using any level of variable rate debt or bridge debt really put themselves in a vulnerable position. Across the industry, the things that have really taken it on the chin, multifamily, especially apartment complexes that are using high amounts of bridge debt and variable rate debt, and obviously office space, which is typically at about 40 to 50% vacancy right now across the country. That's really, really been tough as well. The beauty of what we don't just do storage, right? And this isn't a commercial for us, but I want to use this as an example. Storage as a whole is a great industry, but we don't buy storage and we don't build self-storage. We're buying nasty old big box retail buildings that nobody else wants, and we convert it to storage for about half the cost of new construction. At the same time, there's people out there buying old mills and factories and office buildings and converting it into warehouse or into multifamily space. So right now, the operators that are doing very well are the ones that have a skill set like construction and typically are going after strategy, which we call adaptive reuse. You're looking at what the market gives you when we have a bad economy right now, and you're looking at, well, what can I make out of that? Like as that rises from the ashes, what can we turn that into? Because when you change the asset class, you change the formula by which the asset is valued, and it gives you room for a lot of appreciation. Our deals, and again, that's just an example of adaptive reuse, they do really well because we still always get fixed rate debt. The bank is looking at, say we're buying an old Kmart building. It's been empty for 8 to 10 years. There's very little appetite for 100,000 square feet of big box retail space. Typically, we're buying that building for 1 to 2 million below the appraised value and significantly below the replacement cost. So the bank looks at that and is willing to give fixed rate debt on that because you're already buying something that's worth so much more than what you're paying for it, that you can get long-term fixed rate debt. And then by the time we convert it to storage, there's this huge value add. So it really comes down to, what's your value add strategy? If you're buying a multifamily apartment complex and it's a B or a C class and you're buying it on variable rate debt and your margin is, well, you're going to add stainless steel and granite countertops and you're going to increase the rents and the net operating income is going to go up and the value of the property is going to go up by 30 to 35%. Well, then when you have your variable rate debt increase so drastically, so fast, you can be upside down very, very quickly. So the people that are doing really well right now are the ones that have the ability to do construction in-house and control some of that risk. Whether it's your listener base and they're operating actively or invested with another operator, you have to have 3 things to have success in any type of real estate. It's time, it's experience, and it's money. And especially on that experience component, people that control some of their fixed costs through construction is really important. And I think that now is a really important time to talk about diversification across your portfolio, whether you're doing it actively or partnering with an operator. We all talk about diversifying with different assets and different asset classes, different geography, and different operators. Well, I think that's 3 out of the 5 components that we should be talking about. It's different assets and different asset classes, different geography, different operators, different time structure on when the deal is going to mature, and the debt structure. If you have 8 different investments with 8 different operators, and you're in vineyards and RV parks and car washes and mobile homes and storage, but they're all using the same variable rate debt structure, your entire portfolio is exposed, even though you feel like you have a good diversification strategy. So that's some of the pitfalls that we're seeing right now. And as always, when times get hard, you're seeing the cream rise to the top. A few years ago, every operator looked like a genius. And now the ones that are doing it well and control their construction are doing great and still moving. And there's a lot of other people where their websites have come down, their social media has gone quiet and things like that. And I'm sure they'll pop up when things start roaring again.
Yeah, really interesting. And so we'll talk about self-storage, and it sounds like Nomad Capital focuses in on that. And so you raise a syndication fund for self-storage, or how does Nomad Capital differ from other syndications? What is your strategic focus?
Yeah, so look, there's nothing that special about storage. We're renting someone a box of air. There's nothing inherently special about what we're doing. The way that we do it is a little bit different. We are syndication. Basically, that just means that we pool capital together from investors. We raise money from a group of people. We put money in ourselves, and we take that money and we take on projects larger than what any one individual could likely handle on their own, right? We're taking other people's money and putting in our time and our experience. So we still have those three things that we need to have success. So over the past 2.5 years, we did 2 Kmarts, 3 warehouses, 2 textile mills, a grocery store, and an old soda bottling facility. And we would raise money for those deals as individual deals. So 12 to 17 people would put in the $1 million. We usually only needed, $1.5 to $3 million, would give us the money we needed to buy the building, do the conversion. And then on the back end, we would fill it up, stabilize it with in-house property management. A typical deal for us looks like we're going to buy the building for a couple million. We'll put $2 to $3 million into it. And as a stabilized self-storage facility, it'll be worth 13 to 17 million. So it's a huge value add. From there, everybody's getting preferred return plus cash flow. And then typically our model is we do a cash out refinance. Everybody gets a return of capital plus a big chunk on top. When we do it by way of refinance, it's non-taxable because it's not a capital gain. From there, everyone stays in. We hold it with our partners and it's a long-term hold. So that's what we did with individual deals. This year, I'm about 70% of the way through a fund. We have a $10 million fund. I've got, I think, 6.8 million in the bank right now. It's been deployed. So we got about 3 and some change left. So it's a $10 million fund that we're using to purchase $30 million worth of projects, which are being converted into $70 to $80 million worth of climate controlled storage. So we like it this way. It's been a little bit more challenging because of the down year that we're in right now. But we've already closed on the first 2 properties and they're under construction. We have 3 more under contract. So any investment into that fund gives someone ownership across 5 self-storage facilities across the Southeast.
Yeah, and then moving on, you talk about technological innovations in self-storage. How is technology transforming the self-storage industries? And in your facilities, are there any innovations you've integrated?
Yeah, in a big way. And let's talk about why, right? I want to answer that question, but there's been a big shift in the consumer for self-storage. And so if any of your listeners are thinking about this as an asset class, I'll give you a very quick version of what's happening. We used to think of self-storage as baby boomers in the property once, twice, 3 times a year with Christmas decorations and bulky furniture. That's not it anymore. The millennial population is now 34% of the population, largest population segment in the country. They're also the number 1 users of storage. They use 38% of storage, but the way that they are using it is very different. Instead of being in the property once or twice a year, they're in there once or twice a month, if not once or twice a week. They still have stuff, but it's lifestyle items. The millennial generation is not buying houses, unfortunately. They're renting. When you rent, that means it doesn't come with a garage or a basement or an attic most of the time. You're renting based upon the amount of square footage that you get. So as they are renting smaller spaces, they are using storage as an extension of the closet, extension of the garage, right? They need to be able to get in at 6 a.m. on a Saturday, get their winter clothes and their snowboard and get out of town. So the way that they're using it is different. The consumer is different. So storage needs to be different. And if you're going to invest in storage these days, it needs to be several things: safe, secure, well-lit, easy access, centrally located, and it needs to be climate controlled. And because of that, the innovative technology that's available now is more important than it ever has been. And that goes from everything from access, like QR codes on the door and touchscreen kiosks. It also gives you the option of, once you hit the 60% occupancy, you can pull staff off of there and manage it remotely if you'd like to. But the technology also comes into play from everything from the LED lights to the climate controlled and making sure that you're turning on the climate control when the cost of electricity is down. There's a lot of different things that you can leverage, automate the payment systems and the invoicing and eviction process and everything else. And you're basically taking an old Kmart building and turning a 97,000 square foot building into a giant ATM with 750 units inside that you can run from your phone.
The follow-up question to that is, in terms of the self-storage, the future trends, what trends do you see for shaping the future, and how is Nomad Capital preparing to adapt to these changes?
The number one thing about storage, like the biggest competitor for storage, is more storage. So being very careful about where you're placing it. A lot of people are building storage where they see the path of development. So we want to go the opposite direction, right? If that's where everybody's moving, we want to do the opposite. So our model is not to look for a market that we think is going to need storage in the future. We want to look for markets that need storage now that are underserved. So we look at small secondary and tertiary markets across the Southeast. Instead of finding 5 to 7 or 8 acres that we could build on from the ground up, that's going to cost us $120 a square foot for the construction plus the cost of the land. And to find that much land, it's typically on the outside of town. We're going to do the opposite. We're going to go right in the middle of town. We're going to find the old grocery store, the old Piggly Wiggly, the old Kmart, an old textile mill that's right in the middle of town, centrally located, good residential density in a 1, 3, 5, and 7 mile radius. We can buy that shell for a fraction of what we could build it for. And 12 to 14 months later, we can have it open. Versus ground up development is going to be 3 to 4 years by the time you do entitlement, permitting, engineering, and everything else. So we want to buy that building for dirt cheap because there's very little appetite for big box retail. Across that portfolio I told you earlier, for costs of the building, the land, the construction, parking lot, everything, our average is just under $65 a square foot. So it's not just what you said is a really intelligent question. The trends that we're seeing coming down the pipeline. There's also the time to market and the speed. And if we move into a market that's currently underserved for storage because they're having massive population growth pushed out of these primary markets into these secondary and tertiary small towns around that larger city, they're underserved for storage as is. We can move in quickly. And if I drop 100,000 square feet of storage in that market, it's very hard for a competitor to come in. If they can find a place to put it, it's going to take them 2, 3, 4 years to do that. We're going to be full long before then. And our cost basis is half of what theirs is. So we're very bullish on storage for the long term. The other thing about storage is wildly inflation resistant, because the only commercial asset class that is more inflation resistant than storage is hospitality, because a hotel can change their rents on a night to night basis. Storage is always month to month, right? So it's not a 1 or a 2 year lease on an apartment complex. And then you get into a situation like a year or two ago, we have 9% inflation, right? We can adjust with that on a month to month basis, and it's good for the long term hold. Ultimately, what we can't control is the supply. The enemy of storage is always more storage. But if what we can control is that our initial cost basis is going to be half per square foot what yours is, it's going to be very hard for somebody to come in and undercut us if they try to.
Interesting. How can people find out more about Nomad Capital and follow you guys and check your work out?
Yeah, the best way is you can connect through our website, nomadcapital.us. You can email me directly, clint@nomadcapital.us. We're also on Instagram and Facebook, but that's the best way to keep track of what we're up to.
Excellent. And for all the audience, let's thank Clint for coming on, and interesting take on self-storage, and all the links will be in the show notes. And thanks again.
Thank you, sir. Appreciate you.